So my name is Dr. Anderson, and I'm in the Finance and Economics Department, and I'm glad that you all took advantage of this opportunity, and I hope you're going to attend some other events this week. So tonight we are fortunate to have Tim Tips here. Tim Tips is the Vice President and Residential Lender for Wilson Bank and Trust. He has been in the lending business for about 20 years. He also has over 12 years experience as a real estate appraiser and has been a small business owner and part-time farmer. Tim Tips has an MTSU family. Both he and his wife went to MTSU. His son currently goes to MTSU, and he has a daughter that attended MTSU as well. He is a native of Franklin County, and he currently lives in Murfreesboro. So before we get started with Mr. Tips, we have some polls set up that I want you to answer. In addition, and they're anonymous, so we're not going to know who said what. While we're doing the polls, Mr. Tips would also like you to put in the chat any specific topics that you want him to talk about tonight, and we'll address those after we do the polls. Okay? All right, so here's poll number 1. Still waiting for, I think that's it. All right. So mainly 18 to 24 and 125-30. All right, here's poll number 2. We kind of did this, but now let's see what it looks like. Okay, so it looks like we got 1 freshman, 1 sophomore, 3 juniors, and a senior. All right, let's go with poll number 3. Okay, majority work part-time. Okay, poll number 4. Okay. Poll number 5. Okay. Poll number 6. Okay, you got that, Tim?
What are the numbers on those?
So 80% have a credit card.
80% have a credit card.
80% have student loan.
80% have student loans.
Only 20% have a car loan. And 60% know their credit score.
Wow. Okay.
All right, question number 7, and this is the last question. All right, can you see these? 50% exercise regularly, 67% use a planner or a journal, and 67% have a monthly budget.
How many had bank accounts?
Let's go back. That was question 4. 100% had a bank account. And 80% pay their bills online, and 80% use their debit card.
Okay. Good deal. Okay.
All right, so if you are present in this meeting, you must turn your camera on. Please do so now, or you're not gonna get credit for attending. So I'm waiting for Miriam and Shelby to turn their cameras on. All right, Mr. Tibbs. Okay, anybody have a topic that they want to discuss? Because no one put anything in the chat, and I know you're busy doing polls. So if you have a topic, go ahead and unmute yourself and tell us what you want Mr. Tibbs to talk about for sure. Anybody?
For me, I know one was maybe some tips on how to increase your credit score.
Okay, great, good.
Okay.
Got that on set up. So anything else? I know Taylor mentioned about paying for college and college debt, I think.
Yep.
We'll try to touch on that a little bit. If there's nothing else, let me kind of give you an overview what I had planned to talk about. I want to touch on one of the reasons for the poll question about do you exercise regularly, first of all, is addressing the question about financial fitness. So, I'm impressed by the polling questions to see how many of you keep a planner and a monthly budget, and half of you are in some type of exercise routine or workout. So, that kind of parallels with financial fitness. If you're, what is financial fitness, and are you practicing it? And part of that is keeping a planner or journal and keeping a monthly budget. In addition to that, we'll talk about credit. That's going to include credit scores, how to improve the credit scores. With time remaining, move into from there to budgeting. And then last couple of things, just briefly on smart debt, or the term smart debt, what does that mean? And then I have some tips for my name's Tim Tips. I like to use tips a lot, so I'll have some tips for you from Tim for college students and those that are preparing to graduate pretty soon. So first of all, with financial fitness, I talked about the importance of being physically fit, as we know, and having a regular exercise routine, workout. Part of being financially fit is being organized. I know here we are in April, but a lot of us at the beginning of the year, we start thinking about goals and setting goals for the year. I know in my work as a banker, as a lender, particularly with the goals for production, we think about the year ahead and start establishing goals and how we're going to achieve those. And part of that starts with getting organized and having a system to be prepared for that, and to talk about fitness goals and to talk about planning and for the year as a whole. And one thing about it, I would say, in terms of being financially fit, is to create an organization system of your finances that works for you. It's very simple as possibly having folders, or having, many of us have apps on our phones that can help us with a filing system. That's important. I think it's a good start to have that. Also, being fit goes back with what your lifestyle choices here about having that budget, creating the budget where you're tracking your income and your expenses, knowing how much is coming in and how much is spent. I know it was, I believe, Elena has got her own business, and with that business being fit with your business enterprise, Elena is trying to project what kind of income and that kind of expense you're going to have in addition to maybe other employment, other resources you have. But tracking those things and keeping up with it, how you spend your money, where your money goes, setting goals for the year and where you're going to spend that money, and then tracking periodically, typically at least monthly, to determine whether you need to adjust your spending or whether you need to look at other options as far as other income sources as well. Another thing, how many of you have car loans? I think it was just about all of you have a car loan that you're making payments on.
Most of
Sure.
them had cars, but only 20% had a car loan.
Oh, okay. Okay. Well, that's good. Because I was going to talk about, another part of being financially fit is managing your debt. Uh, you know, how many of you have got student loans? If I could see a show of hands. So looks like all of you do. And I know that it's a big deal for all of you. My daughter, fortunately, she completed her undergrad last year at Lincoln Memorial, and she's now a first-year vet student in Georgia, and out-of-state tuition and all excessive, especially going to graduate schools are very expensive. Being an undergrad, having that obligation, I understand. I've been there, and look at that as a means, as an investment in yourself. Do your best as you can in your financial fitness to avoid other debts that aren't necessarily what I would, this kind of back at the end, a smart debt, if you will, and look at college debt as a means of improving your situation, your investment in yourself, and use that wisely. Staying in school, making sure that working on the grades is important toward that fitness as well. But as an overview, just trying to lower your debt as much as possible or minimize your debt as much as possible.
Mr. Fitz, can I interject something here or ask a
Certainly.
question as well? So
Certainly.
I'm curious as to how many of you have applied for scholarships to help offset some of your student debt?
Yes, good question.
So 2 of you. So Taylor, why no scholarship applications?
I honestly just never thought about it.
So I'm gonna tell you, just in the economic and finance department alone, we have probably 25 scholarships that we award every year. And we send out a message to apply for those scholarships. And if you're an econ finance minor, you could actually apply for those as well. I will also say that at the end of this week, every single student has the opportunity to apply for a $1,000 scholarship from the Ethics and Financial Literacy Week. So you should go onto the same webpage that gave you the link to register for this event. That's an opportunity to apply for $1,000. And I know, Michael, you're a senior, but you're still going to be here till December. You can still apply, right? So as long as you're still going to school after this semester, you can apply. And I encourage you to do so, because I can tell you there are a ton of scholarships that go unawarded every year simply because students don't apply for them. And that's how to
Absolutely.
help offset. So sorry to interject, Tim, but I just want to make sure they heard that.
No, I'm glad you did. And to follow up on what Dr. Anderson said, I can tell you firsthand, we were fortunate with my daughter that she had academic scholarships and was able to go 4 years at a school where their total cost of attendance is about $35,000 a year. She was essentially able to get through those 4 years free, nearly free. But in addition to the Hope Scholarship, which hopefully you all that are Tennessee residents have received and are continuing to receive, but there's other scholarships like that. But there's scholarships, even though you have to make it almost a part-time job. We did that. We are continuing to do that, applying for different scholarships, and we've got some that are, or she has some that are perpetual, or a couple that are. But back when I went to college in the dark ages, the access was not there. Here, I look at, I'm trying to think of the different sites, Niche, and there's several others that I actually apply for just about every month or every so often, hoping that we're going to get something out of that. And you just have to really just set aside, it's really, if you set aside maybe 30 minutes a week to get online, scan those things that are looking at your particular station in life, whether you're, male, female, of a minority, and just finding there's tons of things out there, and it just takes a little effort to hit on some of those, and every little bit helps. Every little bit will help defray that much more that you don't have to come up with a student loan. So that's a very good. I'm glad Dr. Anderson brought that up, and that if you aren't applying, you should. So moving on, about being financially fit. I also want to talk about being ready to address those issues in addition to debt, but also being prepared to meet some unexpected expenses. You got a car, you never know, car's going to break down, tires are going to wear out, and you want to have some savings set aside for those emergency expenses. And also, I would say that being fit in trying to, for you that have part-time jobs, and I don't think any of you have a full-time job, but if you do, trying to set aside at least 10% if you can of what you have coming in from earnings toward trying to save it and live off the rest as a general rule. We talked about creating a financial plan. Part of that is that budget for those that are budgeting. I think you know what I'm talking about. Tracking that income, as I said earlier, tracking all your expenses. You got expenses like your cell phone that may be is different every month. As you're doing your expenses and doing your budgeting, it's a good idea to average those things out. If you got rent, obviously that's got to come off the top. And then with whatever's left over, try to save. And there's things that you can do to limit your expenses. For example, as you're budgeting, again, tracking all those things, even the going through Starbucks or snacks, keep a track of those things and see how much you're spending on a monthly basis. And to save money, cut back on some of those, cut back on some of the eating out. And if you're able to, if you live in an apartment, I don't know how any of y'all live in the dorms. We have any in the dorms? Okay, so you're able to cook and do some things at home. I suggest that you do that to take, or using your meal card, at school to minimize your eating out will help you save.
Mr. Tips, a question for them and then a question for you. So Mr. Tips talked about emergencies. How much do you need to have saved for your emergencies, every emergency fund? How much do you think you're supposed to have saved for an emergency fund? Michael?
I would say like $3,000.
There's actually a specific number of months. So you're supposed to strive to get 3 to 6 months of your expenses saved. So think about that. Take all your expenses in a given month and multiply that by 3 to 6, and that's how much you should have in emergency funds. And that really came to light in March 2020 when the pandemic really hit and people lost their jobs, and we found how quickly people were living paycheck to paycheck. And so I encourage you to think about saving for those emergencies. But now a question to Mr. Tips. Mr. Tips, when should these students start saving for retirement?
Now,
Now,
believe it or not, now, if
but
you
they
can.
don't work. But they don't work now, Tim. So why would they be saving for retirement? I agree that now is the right answer, but explain to them why now is a time to start, even though they're not really working.
Because you're going to reach my age right before you know it. And I can tell you, from past experiences, I've worked for companies. I've had my own business. And when I had my own business, it was only I that was paying myself to save for retirement. And when I worked in like the business that I work for now, the bank I work for now, we have 401k plans. But the value of saving when you're young and how that builds wealth over time, the multiple, it just multiplies the dollar cost averaging of money you put into to 401ks and other forms of retirement will grow just exponentially if you start early.
So I asked that question because Mr. Tip suggested that you save 10%. And I'm suggesting that you consider how you save that money, right? So right now you should be allocating a certain percentage to that emergency fund until you get it to at least 3 months of your expenses. And then once you hit 3 months of your expenses, then you can shift what you've been putting in emergency fund over to your retirement, which should be a percentage of what your savings now. Now here's the kicker. Don't go into the emergency fund unless it's really an emergency. Right? Not having enough money because you've been overspending your budget is not an emergency. That's poor planning, right? So
Right.
It really takes discipline to not touch that emergency fund until you really have an emergency. So a car breaking down can be an emergency if you need that car to get to work. But a car breaking down when you don't drive it every day maybe isn't an emergency. Maybe it's something that you need to figure out around. But that's part of this discipline. And so then if you factor in your student debt, you're going to have so much that you got to pay every month. You can begin to think about that because that's part of your budget as well. And if you're setting that aside, you might be able to borrow less now than you're borrowing because you're actually saving to pay for your education up front. So, Mr. Tips.
Yes, thank you. And I would, to add to that, I would say, first and foremost, 3 months of your expenses. Once you have 3 months of your expenses, I would even strive a little more to have 3 months of my earnings, my income, just like the pandemic, because that should be more than your expenses, we hope. Your expenses, I would hope, are probably no more than 70% because we want 10% for savings and we need to have, other things set aside. But if you do that, then you work toward that 6 months of your living expense, and then start saving for sure, at least 10%, and then grow that and start diverting some of that because we want to plan. You're going to replace a car, so think about that. That may be one pot that I'm putting savings into so that I don't have to borrow 100% when I need to replace the car. I know you're going to want to have a home down the road and dedicating that toward a pot, even dedicating toward a vacation, because using credit to go out and take a vacation is a train wreck. And some people do it, but those are things delaying the pleasure sometimes is a very prudent thing to do. But at any rate, that's very important to try to set aside for retirement. The sooner the better. As a piece of advice about that, once you have started once you have graduated and you are working full time, that's one of the things you want to look at as you're considering where you go to work. That may weigh a company that will have a 401k plan for you versus a similar company that doesn't, where they're going to match your investment. You're getting paid double, for your retirement, which is a wise thing to do. So,
Mr.
Nick.
Tip, can you go back to student debt for a minute and give the students some advice about interest rates and what they should be looking for and maybe things they can do after they graduate to renegotiate that rate?
Well, just and I just a full disclosure, I don't do student lending. I never have. Our bank is not a student lender, but your first source is to check on campus with the different types of financial aid that are available there. But just like you would shop for a car, you want to shop for interest rates. There's a lot of, and again, back online, I find that there's Discover that's big time in the student lending area. Just look at those interest rates that they're offering. Look at the interest rates that you have through, I guess, TSAC and in other government programs that the university is affiliated with. Compare those to the I guess the outside lenders and what their rates are, particularly if there's any kind of a variable rate, in that versus one where your rate's fixed. And what I'm talking about there is, the fixed rate, the interest rate's not going to change for as long as you have the loan. The other thing with the variable rate, I think there's some scale on that it can be set for so long and then adjust after that. When you get out of school, again, having that student loan debt as opposed to bank debt to get your way through school or some other source other than a family member that's willing to invest in you. Having that student loan debt, that government, that secured debt like that can be part of your negotiating with an employer. If you come out and you're valued as a really strong asset to a company, particularly as in the healthcare fields and others, some of that debt can be forgiven over time. So that's important on the front end in searching at loans that may have a forgivable option to them, or a portion of that that's forgivable over time, but also being aware of, again, back when you get out into the job market, looking at those employers that may have a program, a bonus, or some other type of thing that may help you defray some of your student loan expense.
And a couple things to think about is, we know interest rates are very low right now. So you should not sign a variable rate loan today because rates are going to go up, right? So your best bet is to lock in a rate. You want to get a variable rate loan when you think rates are going to go down again. We know they're very low today. So you wouldn't want to do that. The programs that Mr. Tips just mentioned, I know Teach for America can also give you some loan forgiveness. So there's various organizations that do that. And those are things that you want to look at. And then if you really are keeping up with your loan payments, you can always call your lender and try to renegotiate interest rates 2 or 3 years after you graduate because you've been consistent on paying them back, right? So the worst they can tell you is no, we won't renegotiate your rate. The best they can tell you is sure, we're going to lower your rate or whatever it is. So don't be afraid to ask. But the key is making sure you stay current on your debt and making sure you shop around for the best rate. Don't just take the first one the school gets you. Pick up the phone, go online, see if you can get a better rate somewhere else and get your debt that way, right? The first shop is not always the best shop.
Take time to read through the fine print, regardless of which lender that may be. And as she said, don't be afraid to ask questions. They're there to serve you, not the other way around. So make sure you take time to think through it, and don't be afraid to ask a mentor to give you some advice. It may be your banker where you all are banking. Don't be afraid to ask questions there from folks that can help you with those questions. And then of course the advisors on campus can be a resource to help you with those questions. Anything else about financial planning? If not, I want to change gears a little bit and talk about credit in general. Anybody have any other questions on that? Okay. Talking about credit. First of all, you may have heard of the term the C's of credit. It can be referred to as the 3 C's of credit, the 5 C's of credit. What is that? And just as a general rule, as you think about credit, we as lenders are looking at your C's of credit, and one of those is your character. And what that means is, do you or will you repay your debts? We want to make sure, whether it's for a credit card, a car loan, home loan, whatever, or even you going and getting a cell phone on credit, or your creditor that's providing you that service, they want to make sure you have the demonstrated experience or capacity that you will, or the character that you will pay your debt on, that if when it comes due. The other C is capacity, and that's simply more, not only have you shown that you will repay your debt, it's can you repay your debt? And that's going back to our budgeting and financial planning about your income versus your expenses or your loans. And that's a very important model to us, because you may have the greatest credit or character in the world, but if you don't have the income, that's what repays the loan, or that's what repays it pays the bill every month. So that's an important factor. We also look at another C that we look at is capital, and I get what that means is your assets, like what do you own versus what do you owe. And we look at what you own as your bank account, how much you got in your savings account, your car, if you got a car that's paid for, if by chance you happen to have real estate or an equipment or some other type of tangible asset. All those things total what you own and what your capital is. And those are the things that are your resource if something happens and you're not able, you lack the capacity to pay your loan. So think about that. And another, another part of capital we talk about is collateral. And collateral sometimes is that tangible asset that you pledge to a bank or to a lender in the event you weren't able to repay. And that would be like a house, a car, or an ATV or whatever, motorcycle. So those are those C's. And the last C I want to talk about deals with credit scores and credit reporting services.
So, Mr. Sips, before you go there, I know you're talking about a bank, but can you just speak for a moment about the importance of avoiding payday lenders and kind of the quick shops on the side of the road, and while they may give you the money, they're not going to look at those C's because they're going to charge an arm and a leg. Can you just kind of speak to the value of using a bank as opposed to one of those quick shops?
Well, and I will start out by, I guess, qualifying that. There's finance companies. There's a number of them, very, licensed and very credible places. And then there's, of course, banks. But the payday loans, the title loan companies, even though they have certain regulations to follow, it's still you pay an exorbitant amount of interest compared to finance companies and or banks. It's a revolving, I guess, a vicious revolving cycle, and it's typically very small amounts of money, but it just continues to snowball because of the turnaround time. And again, it goes back, it really starts first and foremost from the lack of having an emergency fund or having adequate savings on the side. And then again, things happen, but you're much better off. And again, the importance of having relationship with a bank in that or finance company, but particularly a bank where you already have a track record by the way you've handled your checking accounts or your savings accounts, and being able to go to them in a time of need, or a cash advance on a credit card. And that's probably the worst case, but certainly much cheaper and much less problematic than going to a payday loan company. I would avoid those with the plague or like the plague. So yeah, thanks for bringing that up. Any questions at that point? If you got something you want to put it on the chat, go ahead and do that. Talking about credit score, what is a credit score? Where do credit scores come from? That seems to be, y'all, I was impressed to see that. I think that ratio was
It was 60%, so they knew their credit.
you knew what your credit score was. And I would suggest, that may be the source you're getting that from is probably what, Credit Karma? Show of hands that where
Go ahead
Okay,
and unmute and tell us where you get your credit score from. Michael, can't hear you.
Hello, can you hear me?
Yeah,
All right, so Discover has a FICO credit score that we can
Okay.
use.
okay, that's a
So
good, that's
that's
a
the
good
one I
source.
use. Yeah.
good source. Free
Anybody
source.
else where you get your credit score from? Jeremy? Jeremy went away.
Yep. I see Jeremy, but he's on mute.
Jeremy, where do you get your credit score from?
Um, can you hear me?
Yep,
I get mine from FICO too, from the Discover app.
okay. Elena, where do you get yours from?
Mine is Credit Karma.
Credit Karma? Taylor?
I don't know mine.
Don't know. We're gonna come back to you. Tyler, where do you get your credit score from?
I also do not know mine.
Okay. Shelby, where do you get your credit score from?
I don't know mine either.
Don't know. Isabel?
I don't know mine either.
Okay, so you got 3 that know it and 4 that don't, Tim.
All right, good. Thank you. First of all, there's 3 credit reporting agencies, and that's Equifax, Experian, and TransUnion. Now, Credit Karma is a resource from other vendors. You know, of course, Discover. I can tell you that Discover gets their credit data from those 3 sources. And the FICO score that you hear talked about commonly, that is a data service that's well over 30 years old that developed this scoring system. And it stands for Fair Isaac Corporation. And they developed it. And that FICO score is in use by over 90 or at least 90% of lenders. That factors into their lending decisions. You know, insurance companies also use FICO scores, credit scores. That can have an impact on your premiums. The higher your score, the less risk they feel like you are. So it's actually saves you money by having good credit scores. It saves you on interest by having good credit scores. And Credit Karma gets that information, but it's not quite the same. It doesn't have I find that their reliability it's good. It's a good source, but it's not absolute like mirroring FICO, for example, that these other 3 bureaus use.
So do you have a source that you would recommend they get it from?
Well, again, I would suggest, particularly for the folks that did not get their credit score or do not have their credit scores, I will tell you all, those as well as you that have checked your credit scores, you can also go to freecreditreport.com or annualreport.com, and you can order your credit report for free once a year. You can add to that to get the actual score, but the value, and I recommend this as a part of your overall financial fitness routine, is to check your credit once a year and get the exact full report so that you can see what creditors have inquired on your credit. You can see what credit is reported out there. And if you find something that's fraudulent, you want to stop and you want to dispute that, and you want the credit companies, the credit reporting agencies to investigate and clean that up.
I can't stress that enough. I mean, in the age of technology and crypto problems, you should be checking that report every year, no doubt, just because of the issues of identity theft, right? You never know what someone's using your identity for unless you actually look at that report. So you may think you have a really great credit score, and then it turns out that someone stole your identity and borrowed money against you that you had no idea for. And if you don't report it, that means you're responsible for it. So I really encourage you to follow through with what Mr. Tips just suggested and make sure you're looking at your report regularly. I personally have had the experience of having something on my report that was not my own. And I have friends that have had people file taxes under their identities, which means they now have to go through a problem every year of filing taxes. So in this day and age, you have to be responsible for your information, and that means checking it out and looking at it on a regular basis.
Yeah, not only being responsible, but protecting it. And no one is you know, is immune to this. Fact of the matter is, a lot of this goes on with young people, and I'm not talking to you. I mean, I'm talking to people, the kids that once they have a social security number issued, people are can hack those social security numbers and create that identity for even a minor that you don't realize it and until you going out to get a student loan or you're applying for your first car loan, and then look out, someone else has stolen your identity. So it's a big problem. And when I say protect your identity, not only that, but protect your credit card use, and not allowing, that to get out of hand, get where people can steal your ID or steal that information. And if you got papers lying around with any of this personal identification information, make sure you shred it, because it can be used in a lot of ways to create that other identity and affect your credit for a long time. And it's a very difficult thing to unwind from all of that. So
Mr. Tips, what would be a good credit score for a college student?
well, I'm glad you asked that. And first of all, credit scores are generally from as low as a 300 to as high as an 850. Okay. And I'm not going to ask you what your credit score is, but I'll tell you that the ranges of what we ideally look at for credit worthiness is if you have a score between 670 and higher, that's a very good range. If you have a credit score from or good, if you have a credit score that's below 669, that's fair. To as low as 580, that's fair. Not mean you can't get credit, but you will pay more than the person that has a credit score, say, that's 740 or above.
So
My daughter,
I believe Michael asked the question earlier, if my score is below 670, how do I raise my score?
I'm going to talk about that next.
All right.
But as an example, I told Dr. Anderson this as we were visiting several weeks back. I refer to my daughter because she's like you. I mean, she's in grad school now, but when she went off to college, she actually did a study abroad one semester. So we got her a credit card. We got a simple student credit card with the bank, $500 credit limit. And she's used that to buy gas and groceries, and she's paid it off methodically every month. Charged it up, charged it down, kept it, but it always kept it paid off within 30 days. This past year, when she went to UGA, we found it better to purchase a condo for her to live in than rent, with plans of selling it down the road. We put that loan in her name, and when the mortgage company pulled her credit, she had an 803 credit score, and I was flabbergasted. All she did, no job, no steady income, and 803 credit score. So it's possible that you all can have a very high credit score, even as a part-time employee, a full-time student, a part-time employee thing. So let's talk about understanding the credit score first. What the credit score is built into it. These analytics, you're looking at your payment history first and foremost. That's 35% of the weight of your credit score is in your payment history, whether or not you paid your bills on time. A single late payment can be included in that, and it can impact your score negatively, particularly for a late payment that's occurred within the last 12 to 24 months. So you want to avoid that at all costs. And one way to do that is, of course, to have things set up on an automatic draft from a checking account, back to your financial fitness and budgeting, pay things each month before they become due. The next highest percentage of weight on your credit score is what they call a credit utilization. And that's a measurement of how much credit you use in relation to your credit limits. So I'm going to give you an example. Let's say you got 2 credit cards, all right? And each of those have, say, a combined limit of $10,000 credit limit, all right? And let's say that you've got a balance combined to 4,000 of that 10,000. You've got a credit utilization of 40%. All right, that's a real simple math there. That 4,000 to 10,000 limit. The lower that ratio, the better the score. So if you get below 40%, you're going to get more points for having low utilization. If, on the other hand, you max out your credit card every month to 90 or 95%, you're going to lose points because of that credit limit, that credit utilization. And that also plays in not only that, but to your car loan, your home mortgages, and so forth. But that's about 30% of the score is built into credit utilization. The next thing that builds into that credit score is the length of the credit history. So the longer you have credit, the more positive that number can be. And then that accounts for about 15% of the score. With that in mind, it's a good thing is some of the tips I have for improving your credit score I'll cover in a minute. But then lastly, there's new credit and the credit mix. And what we're talking about new credit is how often you've applied for new accounts, and likewise the variety of the credit, the mix of credit, how much of that's revolving credit or credit cards or charge accounts, and or an installment loan for a car, or lastly a mortgage. So those are like 10% each for a total of 100%. Now,
You got about 10 minutes.
all right, I'll wrap up with that.
I just
So-
want to make sure you get to your tips.
Yeah, here's the tips to improving the credit score. The first tip was request a copy of your credit score. We've already talked about. The second is to try to set your bills up on automatic bill pay through your bank account. Use online banking. Use online access to that to pay those bills and to manage those bills. And then also, as you're starting out, in addition to car loans, renting is another way of establishing credit to improve your credit score, particularly with the more of the larger companies that may report your rent to the credit bureau. We talked about credit utilization, keeping the balances low on your credit cards and revolving debt. Only open new accounts for credit as needed. The more you do out shopping, renting cars, whatever, it's going to count against you. About credit length, history, keep those accounts open. Don't, when you pay one off, keep them open. Don't pay them off, pay them off or pay them down, but don't close them. That helps in your credit score. And lastly, the last tip is if you find yourself in trouble financially, reach out to mentors or some credit counseling agencies that are not for profit. Avoid these others because that can get into a racket. Some like the credit, the check cashing agencies as well. So.
And I would like to add, I know sometimes students have parent credit cards or the parents help them out. It would be better for you to put the credit card in your name and have your parents help you pay it so that you can build that credit history, right? Using your parents' credit card is not helping your credit history, it's helping their credit history. So you want to get the credit card in your name, and then if your parents want to help you, they can help you pay it. But once again, you got to be responsible for it because now it's your credit card, right? But the sooner you can get your own credit card, the sooner you can begin to build that history.
Thank you. Kind of shifting gears a little bit quicker into budgeting. We talked a little bit about that in financial management. One thing I wanted to add to that is what I call, or what's called the 50, 20, 30% rule. Part of that is spending 50% of your after-tax income on your needs, 30% on your wants, and trying to save 20%. And this is over and above beyond the either starting with the $1,000 emergency fund or having the emergency funds like we talked about before. And then we're talking about tracking that. Question about debt management. Do we want to build up savings? Yet nobody asked this question, but do you want to think about, do you build up savings or do you pay down debt? It's really, you try to do both on a plan. I try to avoid having to just pay minimum payments on things. And again, try to get the back to the emergency fund. And there's a couple of ways of managing debt, paying off debt, or maybe three in general, but two in particular. There's like a high-low method, which is called the avalanche method. That's where you're taking these bills, you pay them off in the order of the highest interest rate to the lowest. Once you've paid off that one with the highest interest rate, you tack that money, free it up to the next one and tackle that debt next. The way that works towards retiring your debts. The snowball method is probably the most common that everybody knows, maybe the Dave Ramsey theory, for those that have ever listened to him, where you pay off the accounts smallest to largest. And every time you pay off that one, you get motivated toward paying off the next one, and the next, and the next. And then the next thing you know, you've snowballed all that debt, and then you're debt free. And that's a great place to be. Been there, went back again. So, played that plan. As we, I want to touch on smart debt just very briefly. Is there such a thing as smart debt? I would tell you that there is. Smart debts, as I said earlier, even with your student loan, is helping you to invest in yourself toward an end to where you're more employable, or where you're employable at a higher wage. So that's a smart debt. Borrowing money to purchase or invest in an asset that's going to grow or appreciate versus borrowing money on something that's not going to grow, or like taking a vacation, or eating out, or believe it or not, you buying a car. Where real estate generally appreciates in value, a car, as soon as you drive it off a lot, decreases in value. So that can be really, not a smart debt, even though it's a means to get us from point A to point B. In closing, unless there's a question there, a few things that I just want to give you tips on you as college students. Number one, remember that you're in charge. You're going to be responsible for your finances. You need to act accordingly by creating a realistic plan to how you spend your money and where it goes, and stick to that. I said earlier, watch your spending, try to control your money, pace your spending, increase savings where you can, cut the unnecessary expenses where you can, like shopping or eating out too much. We talked about using credit wisely, understanding your credit score, understanding your responsibilities to pay your bills on time, and how you how you use your credit now is going to affect your future. So that's another tip. I don't think I have to tell y'all to use a bank account, because I think every one of y'all had a bank account, because not only having a checking account, a savings account, but our credit cards there, the online banking, the identity theft, and check cashing services are important. We talked about another tip. Tip number 5 is look out for money, applying for scholarships, look for student discounts everywhere you go. I can't stress how important that is, because the money's out there. You just got to spend time searching for it. My 6th tip is, and y'all probably already know this, but new is out. Buy used books and shop around online, for the best deals. And I guess these days, a lot of what you do, y'all don't even have a textbook for your class. So, and that's a good thing. Entertain on a budget. Try to limit the amount, that you have for hanging out. As I said earlier, cooking at home, sampling restaurant recipes instead of eating out. Number 8, be particular when it comes to your money. Don't trust just anybody with your money. Be skeptical of your classmates, friends, salespeople trying to tell you ideas about saving your money. Particularly salespeople. They can really be tough. Number 9, save, because things are going to happen. Be prepared. It may be your computer, it may be your car that's going to break down, or that you got to replace. So save for that. And then the last tip I've got on that: ask your mentors, your parents, ask your bank, because this is a learning experience. And I can guarantee you, people much older than you have a lot to learn about managing their finances. I've seen some horror stories in my career as a banker, with the amount of the decisions they make, and the debt that they take on, that that just creates more problems than they know what to do with.
And I'm going to give you 11 and 12. So number 11, don't buy your wants as soon as you want them. Go home and sleep on it. Because 9 times out of 10, when you wake up in the morning, you don't want it anymore. So you're not going to spend that money, right?
Yeah.
It looks great, but I don't need it. So I'm going to think about it. And by the time you think about it, it's gone. The 12th tip I'm going to say is use cash. So Mr. Tips talked about budgeting, right? If you're using cash and you only put $20 in your pocket when you go out with your friends, you're only going to spend $20. If you have your credit card in your pocket, you're going to spend as much as you want to spend. So leave your credit cards at home and take cash, right? And I know that's foreign to your generation. This idea of cash in your pocket is nutty, right? But what I'm suggesting to you is that if you begin to discipline yourself by only spending a certain amount when you go out, later you can afford to take your credit cards because you're still only going to spend that amount. But right now, until you discipline yourself and plan that out, you're going to find that you're going to really see how much you stop spending, right? And so one of the things I encourage you to do is just for the next 7 to 10 days, write down everything you spend, right? How many times you go to Starbucks, how many times you eat out, whatever it is, write it down, because I think you're going to be surprised about how much money you can save by just tweaking and moving away from those wants and really focusing on what you need, right? I'm not saying you don't need Starbucks, but do you need 2 a day? Probably not, right? And so making those choices as you begin to plan your budget makes a big difference. So use cash.
I came across a statistic along with what Dr. Anderson was saying, that when you buy with credit, you tend to spend about, I think it's 83% more than you would if you paid
83%
cash
more.
or with a debit card. And, you think of that debit card, it's coming right off the top of your checking account. So, that's very good advice.
Yeah.
Uh,
All right, so
let
we
me
got
say
about
this.
3 minutes left.
3 minutes.
You all got questions for Mr. Tips? Anything you want him to expand upon, or anything that maybe he said that you want to go ahead and get him to talk more about?
Okay,
Nobody.
I have to leave you with this one, a couple of quotes. There's a gentleman, and I'll preface this, Sir John Templeton, who was at one time one of the wealthiest people in the world, was a investment broker. That if you ever heard of Franklin Templeton, he's the Templeton in the Franklin Templeton funds. Many time millionaire, billionaire. He says, one of his quotes was, defer your pleasure until the job is done, which goes back to delaying pleasure in order to save effectively. He also said, if you earn $1 and spend $1.10, you'll be a failure. But if you earn $1 and spend 90 cents, you're on the road to success. And he is of a particular fondness to me because he's also from Winchester in Franklin County. And he became he was a Rhodes Scholar, went to Yale and then to Oxford. And as I said, his legacy is well known if you just want to Google Sir John Templeton. But that's very good advice to live by. It's been my pleasure to be with y'all. I hope that you've gained something from this. And Dr. Anderson, be happy to come back or answer any questions that you may have, because I just want to help you avoid some of the things that I wished I'd have known when I was your age. But it's been my pleasure to be with y'all this evening.
Thank you so much, Mr. Tips. And as a reminder to all the students, go on the webpage and figure out how to apply for a scholarship. You are partway on your way there. $1,000 goes a long way towards paying some of your tuition and maybe avoiding some debt. And this is the scholarships that are just from this week, right? And so I encourage you to do that. If you have questions related to debt, feel free to reach out to me. My email is ann.anderson@mtsu.edu, or you can find me on the 3rd floor of the BAS building. All right. Thank you so much, Mr. Tips. And I hope all the students have a great night. And Mr. Tips, if you want to hang around for 1 minute, we'll chat before you take off. I'm going to go ahead and stop the video. Have a good night, everyone. Thanks for coming.
Hey, Ms.
Thank you.
Anderson,
Thank you.
I just want